Okay, picture this. It's March 9th, 2026. You wake up, grab your phone, and check your portfolio, but it's just gone. And it's not down because of a bad earnings report or some random geopolitical event. No, it has been entirely algorithmically harvested. Welcome to The Explainer. Today we're diving into a scenario that honestly sounds like pure science fiction, but as you'll see, the foundation for it is being laid right now. Our sources unpack this concept called quantum portfolio theory, and the implications, they are absolutely wild. 14 seconds. Just let that sink in for a second. According to the projections in our source material, that's exactly how long it took for 3 trading bots you've literally never even heard of, to front-run the entire retail market. In this 2026 scenario, these predictive AIs exploit this invisible fractal pattern in market liquidity, something a human eye could never catch. 14 seconds to completely strip away years of retail investments. It's terrifying.
So why on earth is this happening? Well, it's because Wall Street dropped $3 billion last year alone building this exact predatory reality. They're pouring money into adversarial networks specifically designed to outpace and outmaneuver every traditional investing strategy out there. But, and here's the good news, there is a fascinating defense. The sources we're digging into today outline a brilliant blueprint to build a quantum-resistant portfolio well before these algorithms make traditional investors completely obsolete. Let's dive in.
Section 1. The Algorithmic Predator Landscape. Look at the sheer scale of this shift. By 2026, the data indicates that over 70% of all trade volume isn't just algorithmic, it's actually self-learning. We're talking about adversarial neural networks that evolve every single minute of the trading day. Their main goal isn't really investing anymore. Their goal is to predict your hesitation, front-run your next move, and essentially extract pennies from every single action you take. You have to realize you aren't playing against a human anymore. You're playing against a machine that's learning from your behavior in real time. Because of this, our old defenses are completely failing. You know classic modern portfolio theory, the 60-40 split that's been the gold standard for decades? Our sources explain that going into 2026, it's actually a massive trap. Why? Because in a crisis, algorithmic correlations all converge to 1. These machines are trained on the exact same data, which means they are all going to sell in the exact same way at the exact same time. Your so-called diversification becomes a complete illusion right when you need it the most. The market isn't a straight line anymore. It's practically a 12-dimensional storm, and you simply can't map a tornado with a straight edge ruler.
Section 2. Quantum Portfolio Theory Explained.
All right, so what exactly is QPT? Don't worry, you don't need a supercomputer to understand this. It's fundamentally a mindset shift. QPT is a probabilistic, observer-interactive mathematical framework. Basically, it shifts how we think from those classical straight lines to a fully interactive environment. It models the market as it actually is right now, a fluid system of multiple possible future regimes. Under this framework, the very act of you placing a trade actively changes the market, which in turn changes how the algorithm behaves. Think about it like the jump from classical physics to quantum mechanics. In the old classical mindset, an asset is just a fixed number. It's either right here or it's over there. But in the quantum mindset, assets exist in the superposition probability cloud until they're actually measured. In the high-frequency markets of 2026, the price of an asset isn't a single definitive number. It's a cloud of potential prices, constantly being manipulated by high-speed algorithmic observers. We really have to start thinking in waves, not static data points. Okay, so how does this actually work in practice? Well, QPT models assets as wave functions. Instead of looking at a single historical correlation between 2 stocks, which is basically useless now, it calculates correlation matrices under hundreds of parallel scenarios simultaneously. The source material explains that it functions like running millions of Monte Carlo simulations in a single mathematical breath. The whole point here is to identify a quantum-safe frontier. We're looking for an allocation that stays stable across all possible future market realities that a self-learning AI might try to invent to trap you. Section 3. The Quantum Toolkit. Principle number 1 is the entanglement hedge. The role here is incredibly simple but so profound. Stop pairing your assets by market sector and start pairing them by causal algorithmic reaction. What does that actually mean? Well, our source gives a perfect example. Imagine pairing a high-growth AI stock with a long-dated volatility product. They become quantum entangled if the algorithmic trigger that crashes the AI stock mathematically forces a volatility product to pump. You're not just looking for a negative correlation anymore. You're setting up a direct causal reaction. You're basically forcing the bot's own trading pressure to mathematically stabilize your portfolio. Then we have principle 2, superpositioned liquidity. The key takeaway here is this: never, ever hold a single massive position in cash. If you have a huge block of cash just sitting there as a bid, you're literally a glowing target for these algorithms. They will steamroll you. Instead, you've got to superposition your capital. You distribute your dry powder across stablecoin yield protocols, T-bill ETFs, and instant settlement inverse funds. To the scanning bots looking at the order book, this doesn't look like targetable capital at all. It just looks like unsteamrollable quantum noise. When a crash hits, you just collapse that wave function into the exact cash you need, exactly where the bots aren't looking. Principle 3 completely flips how we exit trades. Algorithms are designed to measure your pain threshold through visible, classic stop losses. If you're using one, you're a target. The bots will literally spike the price just to stop you out on a temporary wick. Decoherence timing fixes this. It uses invisible, self-adjusting, probability-weighted scripts. Think about it. In quantum systems, things only stay coherent until they're measured. With decoherence timing, you get rid of visible stops and only exit or decohere when the market's underlying probability distribution has permanently shifted into a losing state. You're waiting for an actual mathematical regime change, not just a momentary dip. Section 4. The 2026 Step-by-Step Protection Protocol. So our sources don't just leave us with theory. They give us a really concrete 4-step checklist to anchor all this into an immediate, actionable survival strategy. Let's break down exactly how you can deploy this protocol today. For step 1, the stress test, the sources suggest using freely available tools like IBM's Qiskit optimization modules to scan your portfolio for supercorrelation clusters that won't survive an extreme shock. If assets cluster together during a simulated crash, you cut them. For step 2, allocate a 10% quantum tail hedge into assets that mathematically spike during a regime transition, like the jump from human to autonomous market making. Think volatility of volatility instruments or even decentralized insurance pools. Step 3 is absolutely crucial. Deploy a privacy layer. If algorithms can see your orders, they will price them in. Use dark pools, time-weighted slicing, or zero-knowledge proof trading relays. To survive, your portfolio must be unobservable. Finally, step 4, rebalance dynamically. Forget the calendar. Let your portfolio drift freely within a probabilistic safety envelope and only correct it when there's a non-zero chance of catastrophic loss in a parallel market reality. There's this philosophical wrap-up in the source material that just completely hit the nail on the head for me. Quantum portfolio theory isn't really about the math. It's about humility. And that's exactly it. Accepting that the market is a complex adaptive system, and definitely not some predictable mechanical clock, is the key to surviving. By thinking in probabilities instead of absolute certainties, and entanglements instead of distinct sectors, you stop being a predictable target. You become a wave, just flowing effortlessly right through their traps. And that brings us to a really crucial final warning. This 2026 transition, it is going to be absolutely brutal for the people who are still blindly indexing, still putting up visible stop losses, and still clinging to the false hope that a straight-line 60-40 portfolio will save them. But for the quantum-minded investors who adapt right now, it won't just be about protection. It is going to be the greatest wealth transfer in a generation. Wow, we have covered a massive amount of ground in this explainer today, moving from the terrifying reality of adversarial AI to the incredibly empowering toolkit of quantum portfolio theory. Now, I want to pass it over to you. As we keep exploring these concepts, I've got to ask, what is the one asset you would protect at all costs in 2026? Really think about it, jump into the discussion, and help us build a more quantum-literate community. Thanks so much for joining me for this explainer, and remember, always stay nonlinear.